5 minutes there.
Hear me?
Yes. Do you hear me?
Yeah. Can you see my slides?
Right. Excellent. Excellent. So you can start your presentation. I already presented you. So the floor is all yours.
Thank you very much. So I thank the conference organizer for having our paper in the session, and this is probably the least technical paper in the whole workshop. So this is a joint work with my Norwegian colleague and people from universities. So in this paper, we want to better understand the monetary policy transmission to firm investment. So why do we care about this question? Well, this is a new, not a new question because we all understand investment is very important and it explains a large share of business cycles. And also, it is almost a consensus that monetary policy can affect firm investment and then further affects the long-term growth. And nowadays there is a new literature, a new strand of literature trying to better understand the factors that affects the monetary policy transmission to firm investment, and then people tend to propose that different firms are affected by these factors differently, so monetary policy may affect the firms differently. So overall, people would argue for the Hank model, the heterogeneous agent model, to better understand different responses of firm investment to monetary policy. However, we want to make a step backward and ask, well, how much do we understand firms' investment? There are two reasons why we ask this question. First, as we know, a Hank model is very costly. So when you step into the very complicated Hank models, you have to ask how much, to what extent, the benefit you will receive. And second, well, there are a lot of theories arguing for different factors affecting firms' reactions. But as far as we know, most of the theories are based on limited sample of firms, especially the listed firms, because you see you can get access to the financial statements of these firms, but not the rest of the firms in the economy. Right. So then the question is, if your theory explains less than 1% of firms in the economy, to what extent can we generalize your theory to the rest of the economy? So this is the motivation of our paper. So in this paper, we are not inventing any new theory, but rather we want to put all the existing theories into test using the universal universal coverage data from Norway. So what we do in the paper are as follows. So first, we compare the macro level analysis versus micro level analysis and validate our approach so that our micro model can explain the macro behavior of the Norwegian economy. And next, we put all the existing theories into test. So we horse race all the theories and see to what extent these theories explain the macro outcome of Norwegian economy. And further, we raise further questions on the channels of monetary policy transmission to firm investment. So let me tell you more about the details. To tell you the key findings in a nutshell, basically our finding tends to say, well, actually the investment responses to monetary policy, according to the universe Norwegian firms, as if a representative firm investment behavior. So that is, well, the Hank model applying to a whole economy does not give us much add-on to our results. And also for the existing theories, only one theory stands out to give us a significant contribution to the firm's investment response to monetary policy. That is the so-called earning-based borrowing constraint, but the explanatory power is limited. And furthermore, we find that monetary policy works primarily via direct effects, that is, firms' direct response to interest rate changes instead of indirect effects, that is, firms passively react to the general equilibrium effect. And also in terms of direct effect, it seems that firms react mostly to the changes in net present value of their investment opportunities. So let me tell you more about our research. So the data we are using is based on the Norwegian tax record data with on firms. So that is a panel data from 2000 to 2019, and it covers more than 33,000 unique firms. And in our sample, we cover more than 2/3 of annual sales in Norwegian economy in a given year. And also, we combine the data with the firm balance sheet information, income statement, and also the firm characteristics. And in terms of monetary policy shock, we use the Romer type of identification. So the first thing we do in the paper is we want to validate our approach by comparing the Norwegian economy's outcome in using micro data versus using our macro data. So basically, what we do here is a local projections, trying to project the changes in firms' fixed assets. That is our measure of firm investment on the monetary policy shocks. And also we do that on a macro level and also on the micro level using our micro data. And also we include control variables, that is the lags of dependent variables and shocks. And on the micro data, we include a series of controls on the firm level. So let's see the first batch of result. So it seems that our micro data generates very similar pattern to the macro data. So basically, about 4 years, in 4 years' time, the reaction of firm investments to 1% tightening of monetary policy reaches the maximum, which is about 2%. So this basically validates our approach that using microdata for macro analysis makes sense. And then we continue to ask, well, there are a lot of theories telling us, well, firms' reaction to monetary policy in investment are constrained by many factors. So they argue for the Hank model. So the next step, we want to test these existing theories and see whether, to what extent they explain the behavior of the Norwegian economy on the universal firms. So basically, we explain the changes of firms' fixed assets on the interaction term of monetary policy shock and the variable, that is the factor in theory which argues for affecting monetary policy transmission to a firm investment. So that is the coefficient beta h is basically the marginal contribution of this z factor on monetary policy transformation, right? So in order to see whether the theory survives the test, we only need to see whether the reaction beta h is significant or not. So let's see the result. So we basically take the theories from the bookshelf. There are about 6 strands of theories available. That is firm's size, age, earning-based constraints, which is also called the interest coverage ratio. This is the interest expenditure to firm's earning, that is the EBITDA earning. And asset-based constraint, that is on the ratio of fixed assets and total assets. And the leverage ratio, that is debt to asset ratio, and also the liquidity ratio, liquid assets to assets ratio. And also, we did 2 types of exercise. One is the model using only single reaction, that is the reaction including only one of these factors, or the model with all the interactions if you think all those factors matter. So basically, the results are shown in the red line and the blue line respectively. So if you look through all the results, actually there's basically one theory that stands out or pass the test. That is the earning-based constraint. All the others are not significant. Well, there is one, the asset-based constraint, which is a little bit significant at a certain point, but it is not robust if we include a different set of control variables. So all the theories which passes our tests is only the earning-based constraint. Well, of course, you may say probably this is the theory that we should take in our modeling. On first hand, this factor is the impact of earning-based constraint is actually very, very small to explain the firm's reaction to monetary policy. So to give you some impression, basically one standard deviation, that is 64% rise in the interest coverage ratio, only leads to less than 0.7% changes difference in the changes of firm investment to monetary policy. So the impact is very small. And then second, if this is the factor which affects a firm differently, then probably we should still consider the Hank model anyway, right? But if we look at firms through the entire distribution on how they react to monetary policy, we find actually firms behave very similarly. So here in the chart, you see the firms in the bottom 10% percentile versus firms in the top 10% percentile, and how they react to the monetary policy. So actually, you can see their reaction are actually statistically not different. So which means, probably a representative agent model to model firm behavior is enough. So by having putting all the theories in test, we further ask the channels of monetary policy transmission to firm investment. So the question we are asking here is, are firms reacting in their investment directly in response to monetary policy changes, or they are indirectly driven by the other changes in the general equilibrium? For example, firms are driven by the changes of aggregate demand to adjust their investment. This is a very important policy question, because if the firms react to monetary policy indirectly, for example, indirectly to aggregate demand, then from policy maker point of view, we don't need to care about the firms, right? As long as you pin down the aggregate demand, firms will do their things properly. Otherwise, we have to take care about the firms. So we test the channel in 3 different ways. So first, we use the firm's future sales as a control for the general equilibrium effect. So that basically reflects the indirect channel driven from the aggregate demand. Also, we take the firm's proximities to their consumers as a additional control to see whether their reaction is direct or indirect. Because for firms which are closer to their end customers in the supply chain, they must react much stronger to the area demand, right? So by taking this into control, basically we can say whether the effect is driven by the area demand or not. Or we do the third test by looking at the firms in the tradable sector versus firms in the non-tradable sector. Because if firms in the tradable sector, then the aggregate demand shock is rather exogenously, right? It's from the global demand. While for the non-tradable firms, well, their demand shock is basically domestic shock. So if the firms react to the domestic shock, then these type of firms must be different. So let's see the result. So for if we control for the future sales as a policy of area demand, well, on the indirect by controlling such indirect effect does not give us a much different result compared with the baseline result, which means well, the indirect channel is probably not prominent here. And if we control for the proximity of firms to their customers, this does not give us a different result either, right? So this again tells us the indirect channel driven by the area demand is probably not much. And if we compare firms in the tradable versus non-tradable sectors, their behaviors are not very much differently either. This again tells us, well, the indirect channel is probably not driving much our results. So this seems to tell us firms react to monetary policy mostly directly to the monetary policy changes. However, the corporate finance literature also tells us firms may be driven by two different motives. One is firms might react to the cash flow effect as a result of monetary policy, right? For example, if you ease monetary policy, then firms have a higher cash flow, and then firms might use the additional cash flow for their investment. And second is firms might react to monetary policy by the changes in the net present value of their investment opportunities, right? So we want to test which is the driving force of firms' investment. So to see whether firms react to the cash flow as a consequence of monetary policy, we compare two types of firms. One type of firms is firms using a fixed interest rate contract with the banks. And the other type of firms is firms with a floating interest rate. So of course, in our sample, we don't observe which type of contracts firms are using, but we can see the firm's interest rate, right? And then we can basically try to identify the type of contract by looking at the changes of firms' interest rate on their loans. So with a change in monetary policy, if firms' interest rate of their loans is more or less the same, we can conclude these firms are basically fixed interest contract. Otherwise, they are of floating rate. So if we compare these two types of firms under tightening monetary policy, of course, in the chart A, you can see the firms with a fixed rate will enjoy a lower interest rate because their interest rate are fixed, given monetary policy is tightening. And then what are their responses compared to the other firms which have a floating interest rate? As we can see, of course, these firms have lower financial costs. And the only reaction in these firms is these firms increase their equity. However, their investment behavior is more or less the same compared to firms with floating rate. So that is, firms do not react to the cash flow as a consequence of monetary policy. So that is probably firms' investment behavior is driven by the net present value affected by the monetary policy changes. So in the end, we established a very simple model trying to capture our results. So overall, basically using a representative agent model, we are basically able to replicate all our results, which means in terms of monetary policy maker, you probably don't need to go for a Hank model in terms of understanding firms' investment behavior. So I'm running out of time. Let me quickly wrap up. So we use micro level data trying to understand the firm's investment responses to monetary policy. And given the large literature in the bookshelf, we find, there is only one theory which can survive our test, but only for this one theory, the explanatory power is limited. And in terms of monetary policy modeling, we probably do not need a Hank model. And also, monetary policy may affect firms' investment behavior directly through the firm's perception of their investment projects' net present value. So that's all. Thank you very much. I'm very looking forward to your comments. Thank you.
Thank you very much, Jin, for the interesting presentation and very good timing. It is question time now. Any question from the room? No questions? Any online question? Okay, well, thank you very much again. Thank you very much, and we go to the next president.
Thank you.
Okay, another 2 minutes mini break.